for selection of a long-term project. Okay. Use of probability for long-term investment decision making. Why probability is required for investment decision making? For that, see the limitation of certainty. In our basic financial models for investment decision, we often treat future cash flows are guaranteed. That is, after a long period of time, say 5 years, 10 years, 15 years, the inputs like the sale price, demand, cost, etc. are known with certainty, on the basis of which the cash flows are determined. But the reality is demand fluctuates. Demand is not constant always for over a long period of time due to market volatility, change in consumer behavior, etc. I have mentioned on two reasons, but there are so many reasons. Raw material cost, labor cost, etc. All these are changes over time due to cost inflation. It is not like that if the cost per unit say is rupees 70 in this year, and it will be also 70 after 10 years. It will be changed, okay, due to price inflation and so many other economic reasons. A project's life might be cut short due to technological shift by new innovations. That is, the life of the project cannot be determined or forecasted with certainty because technology is changing and there are so many other economic interactions in the market for which the economic life of the project also changes. And these are the reasons for which a single estimated cash flow project life figure often are not practical for determining the acceptance of any long-term project. Then what you have to do? We should incorporate the concept of probabilities with the decision variables. In this case, we consider cash flows and project life are the decision variables. Okay, that means these variables will not be deterministic over the period of time, considering past data and with the forecasted values, probability is to be attached. That is the chances of occurrence of cash flows and project life. Now see, variables consider uncertainty. In this video, we have considered cash flows, project life as the variables with uncertainty. Okay, we assign probabilities to the cash flows considering possible economic scenarios of sale price, demand, cost, etc. for the product. I have already mentioned the project life, which is also not deterministic. The life in years for the project is attached with probability, considering past experience and expected technological changes. For better understanding, we'll discuss a real problem, which we'll solve also. First, see the problem. Then you will get more idea about the uncertainty for selection of a project. Okay. This is the problem. I'm going to read the problem. For ABC Machine Tools Limited, the probability distribution of cash flows and projected lives are as follows. These data are given. What is the cash flows? Here cash flows are not deterministic. 1000 cash flows, the chances for 1000 cash flows will be 2%. That is 0.02 is the probability. So probability attached with the value of cash flows are noted here. Say this line. Cash flows will be rupees 3000 with the probability 0.02. that is 30% in this way. The probability for cash flows, in this case all are cash inflows for determination of the acceptance decision. Cash flows of rupees 4,000, the probability is 0.15. We know the sum total of all probabilities is 1. You can check after adding all these probabilities. This is the total probability. All possibilities are noted here. I think it is clear. For the project life, it is forecasted that the life of the project will be 3 years. The chance is 5%. That is 0.05 in this way. I am not reading all the items. Few items I am reading. Say life of the project will be 7 years. The probability is 0.15. That is 15% in this way. The life of the project 10 years is 2%, means 0.02. That means the project life with probability attached with the project is noted here. It is clear? I have already discussed. Here we will consider not the deterministic value but with probabilities. What you have to do, on the basis of 500 numbers of trials at random numbers, what situation will be happen? It is not deterministic. To make it random, we will use the help of random numbers. We will give trial for 500 numbers of trials at random. All trials are at random, and accordingly you have to take the value of cash inflows and apply for the project. Okay, then what you have to do? You have to find out 1, 2, 3, 4. All these you have to find out 5 up to 5. First, determine the probability that NPV for the project will be positive. Determine the expected NPV. Expected, why? As probability is attached, that's why it is called expected. Otherwise, it will be average. And standard deviation. Standard deviation of NPV. Because 500 trials we are considering, that's why, but with the expected NPV and standard deviation of NPV. Third, determine the expected NPV for 95% confidence level. That is also to be determined. What is the probability for rejecting the project by using traditional probability formula? That is total numbers out of each your requirement, the ratio of that. That is a traditional method. In this problem, assume initial investment for the project rupees 10,000 and discount rate for the project to be considered as 10% in this problem. It may be different to other problems also. Okay. Note, use Excel sheet to generate 500 sets of random numbers and apply Monte Carlo simulation to solve the problem. Here we will apply the Monte Carlo simulation that I will discuss, because manually it is very difficult to calculate for 500 trials. That's why we will use the Excel sheet and the tools of Monte Carlo simulation. And lastly, what you have to do, what you have to find out, what is the probability for rejecting the project using statistical methods, that is considering normal distribution and use of Z value formula, that we know. Okay. Now, so we have discussed the actual formula considering all the situations which we have discussed. Next, now how you will solve problem solving using Excel sheet, that I am going to show you how you will solve the problem. After solving through Excel sheet, the result will be noted here. First, I am going to discuss how we will solve and what will be the result. Now, solving the problem. Okay. Now go to the Excel sheet. I will discuss through 3 sheets of Excel. First, I'm going to give you the concept how you will attach the probability and demand with the random number that I'll discuss first, and also the life of the project. Okay, how you will get the random number? Here you will see this is the formula of random number is equal to RAND. This is the bracket. This is the random number. If you strike anything, if you write anything to any cell, you will see this random number will change as it is random, because this is the electronic sheet that I am showing. See, the random number is 0.233 like that. Now I am writing here something. You can check the random number has been changed. If you write anything on the Excel sheet, immediately the random number will change. So this is the process by which you will get the random number. Okay. Now for this random number, what will be the value of cash flows? How we determine it? And the life of the project. For that, I have shown this is the table of the data. Table of the data. Cash flows 10,000.10. In this way, actually this is cash flows and cumulative probability. If you add, you can see the total will be 1, 35, 40 and 15. So if you add all this, then you will get 45, 50, 60, total is 1. In this way, here you will get, this is the cumulative probability and this is the cash flows. How it is done? The cumulation, the same data I have done here with cumulation. Just to get the idea, I have not shown you the project life because it is similar to the cash flows. Only I have shown you the cash flows, how you will attach the probability with the random number. So if you put on this table, you see in this way you can write. This is the accumulation. This is the accumulation of the probability. First 0, then 0.1, 0 plus 0.1 is 0.1 plus 0.35, that is 0.45, and then add, that is 0.85, and finally it will be 1 if you add 0.15. And the demand against it, 0 is equal to 10,000. In this way you will write it in this table. Sir, why you have written in this way? Because if the cumulative probability is up to 0.1, if even 0.09, the demand will be this, because the probability is 10%. That means up to 10%, the probability value will be taken this, that I will show you. And up to 45, as it is accumulation, if the cumulative probability is 0.45, then the demand will be 20,000 in this way. That means this is the accumulation number and this is the cash flow amount. In this way you have noted. And the variable I have used here, that is called lookup. Lookup. You see, with this variable we have select this range of data. I think it is clear. Now see, this is the random number. I want to get the cash flows. For this random number here used for the cumulative probability we will take, that is 0.55. Then what will be the cash flows? If I am using here the random number as the cumulative probability, because any number of random number may come here. So 0.55 means where up to 0.55 it is above 45.45, but up to this, that means the demand will be 40,000. I think it is clear. 40,000. And what is the formula for? This formula is given to attach this. What is the formula? VLOOK formula is to be given on the basis of B11. This is the value of B11 you see, and lookup is the range of the values, and the second value will be taken. This is the formula I have noted here also. So 0.55 means up to this, the value will take this 40,000, that is 40,000. I can show you by changing the value. This is 0.55. Suppose I am writing here anything I will write, that value will change at random. Suppose this way, what is 0.91220? Then what will be the demand? What will be the cash flows as per data given? 0.91. 0.91 means it is more than that, and up to 1. Up to 1 cumulation, the value will be 60,000. You see, the value is 60,000 as taken. In this way, you can check any other value also, say for any value. Again, it has changed 0.39. Why is that 0.39? 0.7 is up to 0.45. The value will be 20,000. You see the value. In this way, we can use the random number which are relates with the cumulative probability, and accordingly the cash flows will be taken. Just I have discussed here how you will use the tools. Now actual calculation, for actual calculation I am going here, sheet 2. This is the actual calculation. This is the table for annual cash flows. With probability the cash flows are given. This has taken from the given problem. Okay, and this is the project life with probability. Project life with probability, this is the probability input for project life. 3 years life of the project is 5% chances the life of the project will be 3 years. In this way, suppose 8 years life of the project is 0.1. in this way. Then what you have to do? First you have to convert this probability to cumulative probability. This is the cumulative table, and you have put the cash inflows. Accumulation how? Because from starting 0 से start होता है ना, from 0.002 up to 0.02. This is the accumulation first, and the demand will be, sorry, cash flows will be 1000. That means up to 0.022, if the random number is 0.02, the cash flows will be this. Similarly, suppose the random number is up to 0.20, then the cash flow will be 2000. In this way, as I have already discussed in sheet 1, I have prepared this table. Project life is this with probability, sorry, this, and the cumulative we have prepared here. And two range variables we have noted here, that is lookup 1, okay, of lookup 1. This is the variable for lookup 1, and for lookup 2 we have for lookup 2, this is the lookup 2. Now this is the random number is equal to, this is a random number, and simply I drag it. Okay, if you drag it up to 500 observations, then you will get the random number. And this is the formula to get the cash flows attached with the probability. Random number indicates the cumulative probability, 0.84. You can check what will be the 0.84. This is the cumulative 0.84, means up to this, that is 3500. You see, this is 3500 cash flows. In this way, for 0.8616, what will be the cash flows? 0.86 means 0.85 and above. The demand, the cash flows will be 4000. In this way, it is very easy, and you can do only within 3 to 4 minutes up to 500 observations. For project life, this is the project life. This is the project life, and this is the random number for project life. If the random number for project life is 0.86 something, then what will be the life of the project? 0.86. You can check 0.86, 0.6 just below that, above 1. That means 0.86 means 8 years. 8 years. See, 8 years. In this way, I am not discussing all the items, just few items I am discussing. For 0.45, what is the project life? 0.4546, that means just up to this, that is 6 years. In this way, for 0.03, which one you will take? Up to 0.0 will be 3 years. You can see 0. What is the 0.03? 3 years. So in this way, 500 observations we have done. Just drag it. Acha. One thing I need to mention at the same time, this is the calculation of NPV. I have taken the use of the formula for net present value. How? What is the value? You will practice, you will check, is equal to PV means present value. This is the discount rate, and E14. What is the E14? You check if the E14 is the life. E14 is the life, that means 8 years, and minus C14. C14 means cash inflows. And if we do all this, hello, আমি একটু রেকর্ডিং করছি, বুঝে গেছিস? হ্যাঁ, আচ্ছা। So in this way you can find out the net present value with the help of this formula. It is not very hard. You can check it. Up to this is the present value for 8 years of rupees 3,500 cash inflows each year and minus one time cash outflow. In this way I have just dragged it, the formula for every cell up to 500, the NPV value has been calculated. Now here I have given one formula. If the NPV greater than 0, then put 0. If the NPV greater than 0, put 0, otherwise 1. See, this is the NPV, it is greater than 0, that's why 0. The formula is this. You can check it, is Excel formula. In this case, it is negative NPV greater than 0th of 0, otherwise 1. That's why it is 1. That is for all negative NPV, you will get the value 1. In this way, 500 calculations I have made, which will take only, I think, 3 to 4 minutes if you know the process. And after doing that, this is the calculation for average, or you can say min NPV. What is the formula? It is equal to average G14 to G513. G, what is the G? This is the NPV and this is the average formula. You need not to divide. Average means it will sum total of all the values divided by n. That means 2317.49. This is the average. And NPV less than 0, it is counted here. Sum, this is the formula for counting the negative value of NPV. In this case, 159. Okay. And a standard deviation formula is also noted here. This is standard deviation for G14 to, this is the standard deviation for NPV. You will get this NPV. And for calculating the 95% confidence level of mean value, you can check it. Mean NPV plus minus 1.96 NPV minus standard deviation divided by square root of number of iteration. This is the formula that I have noted here. I think you have this basic idea for Excel application of formulas. You will apply that. And this is for 95% confidence level, lower limit, and this is the upper limit. That means lower average value will be 2333 and the upper will be this. That is the maximum limit. And the traditional method, what is the percentage of negative NPV? It is done by here. Age 15, if you add all the 1, then you will get the negative NPV divided by 500. That is 32% cases out of 500 will be negative NPV. And you can say this is the crude method or traditional method of probability, that is chances for rejecting the project is 32%. Okay. Now I am summarizing this result to sheet 3 for discussion of other items. Okay. Again, I am repeating one thing, as when we are striking any cell, any amount, immediately the random number value will change and all the values will change. But the value calculated here, that will be correct, but it will be changed because the random number are attached with the Excel sheet. I think it is clear. For that reason, what we have done, I have in the sheet 3, for any particular combinations, I have saved all the values, only values, no formula. If you not give the formula, then it will not change automatically. So for a particular set, I have saved here 500 units, and then I will discuss the other. Again, I am going to show you sheet 2, how it will change. Here your average value is 2317. Suppose you strike any value here, you will see this average value will change 2300 and 2413. Then why? Because the random number automatically has been changed. Then what you will do for calculations? Then it is advisable you save all the values without formula, only value mode to another sheet 3. Here you can check there is no formula. That is, if you strike here, it will not change. It is for any particular combinations, you will get this. Okay. Now I am showing you the same calculations and I have noted this is the result. This result I have summarized for discussion to the PPT. Okay. Now I am again going back to the PPT. Now I am going back to the PPT. Okay. And this is the returning solving. Up to this we discussed. So this is the summary information of the calculation. Expected NPV is 3943 and the total observations 500 and NPV is less than 0, 165 and the probability for rejecting the project is 165 divided by 33%. Sir, this result is different from the previous one. That I've already discussed because I have taken a specific case. In that case, as the values are changing with the formula, that why I have taken a specific case for discussion. If the rejection probability is this, then what is the acceptance probability? We know the probability is 1 minus 0.33. That's why 60%, 67% probability we can accept the project. Now, finally, we'll use the statistical technique, application of statistical technique for determining the probability for accepting the project. Statistical technique. So we have already calculated expected NPV, net present value is this, standard deviation this. We want to find out the probability that NPV will be less than 0. That means rejection. What is the probability? This may be calculated or done in 2 steps. First, what you will do? The standardized difference between the specified, or this is the formula you can check from any statistics book to find out the Z value. This is 0 and minus the average or expected value divided by standard deviation, and the value comes this minus 0.6058. And second step, you have to check the cumulative probability up to Z is equal to this, which is available in any statistics books or financial management books. From the standard normal distribution table, the value is shown 0.2743. Statistically, the probability for rejection is 27.43%. Then what will be the chances or probability for accepting the project? Is 1 minus 0. This, that is 0.7257 or 72.57. You can accept the project for which the probability or chances is 72.57%. This is all about of the Monte Carlo simulation application for determining the long-term investment decision proposal. Here specifically important as the variables, that means cash inflows and the life of the project, are not considered as fixed or deterministic, which are attached with the probability. Thank you. If you have any query, any doubt, please note to the comment box. I will definitely reply at the earliest possible. Thank you. And if you like this video, and I expect that please put a like and also subscribe to this channel for getting more important valuable videos in future, and also share to your friends. Thank you. Thank you.